Welcome back in, ladies and gentlemen. Today we're going to talk about the cycle, what position I just added, and get into my portfolio overall. And that's probably going to be the format going forward on this channel. So let's just get right into it. We tracked the sector over the last year. There's a couple things that stand out to me and a couple opportunities that I personally see. Number one is going to be consumer staples has been an underperformer, along with utilities down here at the bottom, healthcare, and real estate. So these have been underperformers, and these are where I believe the true opportunities lie within the market, especially if you're picking individual names. Now, of course, I always recommend just dollar cost averaging into a broadly diversified index. But for this example, I want to share something. I believe that we still are in a late cycle behavior here, and I do think there will be a correction. And that's why when I highlight healthcare, staples, and utilities, if I am correct, this is kind of where you want to be positioned. And so when we look at my portfolio, over 30% is sitting in T-bills earning close to 5%. Our largest position, we just grew out to CVS and Pfizer, both in the healthcare sector, and both I believe are tremendously undervalued, and the market is discounting how much these companies can truly earn. Now, of course, there is some headwinds with both of these companies, but I still believe that valuations are making a tremendous amount of sense, especially when we topple in the type of dividend yields that both these companies offer. And so I do think that these two are large opportunities, and I'm extremely overweight both these stocks, probably to an unhealthy amount, but I am looking to deposit more funds and go into T-bills, pushing it closer to 40% of my portfolio, which would then water down these positions as well. Next up is Smucker's, consumer staples. So when we look at my top 4 holdings, I am definitely leaning towards end of cycle behavior. We have risk-free yields sitting at 5%. We have good defensive companies that I think are extremely cheap right now that offer dividend yields. We started building out a position in Cisco recently. And then the new position we added today was BABA. Now, BABA to me is going to serve a few different purposes here. Number one, I think US stocks are expensive. And number two, China is doing a tremendous amount of stimulus, which should eventually trickle through to companies like BABA. Now, BABA's valuation kind of aligns with everything I'm looking for here. Completely depressed valuations, but revenues and earnings are still in an upward direction here. Recently, earnings have kind of been deteriorating, but I do think this is something they can turn around. And I think political tension is priced in extremely high to this company. And I just think the worst is kind of being priced in, especially when we look at a 5-year chart in the recent sell-off on BABA here. I think the risk versus reward, having a small position in this company, less than 5% of my portfolio, I probably would grow it out to be about 5 to 6% of my portfolio. So another few shares would do that. And I think the risk versus reward for a company like BABA makes a tremendous amount of sense. If we look at the valuation of US stock market right now, trading at over 25 times earnings. And when I started building this thesis, it was actually over 26 times earnings. And I did a video explaining yields pushing closer to 18 to 20 times earnings versus putting fresh capital into the S&P 500 at 26 times earnings. And I just didn't think the case was compelling to put new capital in this market over the last, call it, few weeks here when we were reaching all-time highs. Now that we're getting the sell-off and there is more depressed assets going on sale here, to me, I'm looking at more that deep value type positioning that I think can have a substantial earnings upside. So when I think about my investment approach, it's definitely going to be this barbell approach that we've talked about a few different times on the channel. We're between 30 and 40%. I want to be earning a pretty risk-free yield, and you can definitely get over 5% right now, which is pretty compelling when you're talking about a market trading at 26 times earnings. And, I think the growth prospects are pretty intense when we have to figure, in order for us to kind of get historical average earnings, we need almost 15 to 20% consecutive growth rates in this market to get a forward PE sitting closer to 20 or 18 times. So instead of playing that game, I definitely want to lock up 5%, fairly risk-free, and I'm almost halfway with no risk getting to historical averages for market returns. But then on the other side of this barbell is definitely that deep value defensive type names, late cycle names that I'm talking about. And most of these companies are trading for under 10 times earnings or right around 10 times earnings. And I still believe most of them have earnings growth that the market is discounting. And so when we have a market trading at 26 times, I look at these deep value areas and they don't really need to accomplish much to basically have price appreciation, which will then offset the low risk I'm taking on the other side, meaning that I do think that these types of names could actually outperform the overall S&P. Going forward, I kind of want to compare where we are with the S&P 500 versus my barbell approach here, so we can kind of keep track of the progress here or failure that I might have. So currently I have $30,788 versus the S&P sitting at $5,030. So this is just a video. So this will be a video where I can go back and see, and I probably will be adding capital. And this is the thing I don't like about most brokerage accounts. Adding that capital doesn't keep track of your true performance versus the S&P 500, because every time you're putting fresh capital in, the true performance of your portfolio. So we have to be cognizant of that going forward. So we're at 30,788 versus the S&P at 5,030. So I kind of just want to see how this plays out through the next 18 months or so, because I do think that we are late cycle. I think that the S&P has a shot of hitting newer highs. And I do think I can compete with those newer highs, not being completely invested because I'm buying such depressed assets. Of course, these depressed assets are on sale for a reason, right? They have their problems here, and it could be a dangerous move on my part. So we will update here going forward on how our portfolio's working versus the market, but kind of wanted to give you guys what I'm truly doing, why I'm taking the path that I'm taking, and showing you the logic behind everything. And if you're new to the channel, welcome in. I do have a process to coming up with stock prices as well. So I don't just buy blindly here, folks. I try to be as realistic with my expectations on earnings and put price targets that make sense. So just to give you guys an example, I did reach on Pfizer because for me, Pfizer is probably closer to a $24 stock than it is a $27 stock. And I averaged in right around $27 a share. And there's reasons why I kind of reached on it. I did think that there was opportunities for them to kind of turn around their earnings problem that they have with all the acquisitions that they made sooner than later, and that has not been the case. So I do think that this could sell down to under $24 a share. So that's something I personally have to own for reaching on this stock and kind of going against what I normally try to do here and wait for prices to come to me. So hopefully that sheds some light on the strategy I'm personally taking. I'm trying to take that late cycle, end of cycle type strategy here, where I do think healthcare and consumer staples are extremely depressed and cheap. We've been talking a lot about AI and technology, and that's just pushed prices higher and higher, leaving these other stocks kind of the wayside and left for dead. And that's where I think price discovery could actually happen here. I'd rather buy something at 10 times earnings than chase the hype at 30 times earnings. And in doing so, I don't need to put a tremendous amount of capital in there to get price appreciation. So that's why I'm offsetting it with treasuries, because I do think cash is going to be king as we head into some turbulent times towards the end of this year. Now, as I stated in this video, I do think there's an opportunity for the stock market to actually reach newer highs, and it most likely will be technology. But I also think there's a high probability that consumer staples and healthcare start participating pretty soon here, because valuations are getting a little stretched on the top 10% names. As always, guys, really appreciate your time. We will see you in the next one.